The impact of this growing trade relationship is evident in the changing dynamics of Mexico's import sources. In 2023, Mexico was the leading importer of cars made in China, importing a total of $4.6 billion worth of Chinese vehicles. This figure is particularly striking when compared to the $4.4 billion worth of vehicles imported from US-based companies. Chinese automakers have made significant inroads into the Mexican market, with 1 in 10 vehicles sold in Mexico in 2023 being made by a Chinese company, outpacing every other foreign country.
Fueling that trend are simmering trade tensions between Beijing and Washington, an effort to bring U.S. imports closer to home, and a burgeoning Mexican manufacturing base. But there's another factor at play. To avoid American tariffs, Chinese companies are using Mexico as a backdoor to the U.S.
The appeal of Chinese vehicles in Mexico extends beyond just numbers. Even consumers wary of electric cars are drawn to Chinese EVs for their affordable price tags. For instance, BYD sells its Dolphin Mini in Mexico for around 398,000 pesos, approximately $21,000, which is about half the price of the cheapest Tesla. This surge in Chinese automotive presence in Mexico is part of a broader strategy. As Felipe Munoz, an industry expert, explains, however, this booming trade relationship has not gone unnoticed by the United States. As China finds ways to circumvent U.S. tariffs by increasing its presence in Mexico, American authorities have stepped up their scrutiny of Chinese imports in Mexico. In a significant move in August 2024, Mexican authorities, likely under pressure from the U.S., seized over 1.4 million Chinese goods due to documentation issues. This action was part of broader efforts to curb tax evasion through stricter import regulations. The United States-Mexico-Canada Agreement, or USMCA, has become a focal point in this evolving situation. The U.S. has been advocating for stricter USMCA standards, particularly concerning steel. The agreement mandates that steel entering the U.S. through Mexico must be produced within North America to avoid tariffs, a move clearly aimed at limiting Chinese influence in the regional supply chain. Despite these challenges, China and Mexico continue to find mutual benefits in their partnership. For China, Mexico offers a strategic gateway to North America, while Mexico gains significant investment in infrastructure and industrial growth. This win-win situation is evident in the surge of Chinese foreign direct investment (FDI) in Mexico. In 2023, Chinese FDI in Mexico reached a staggering $5.6 billion, a dramatic increase from $267 million in 2018. This represents a 13-year high and signals China's growing commitment to the Mexican market. Since 2020, the arrival of new Chinese firms in Mexico has grown 2.8 times, further underlining this trend. The Ministry of Economy of Nuevo León, a state in northern Mexico, reported that it received $13 billion in investments from October 2021 to April 2023, creating 88,000 new jobs. Chinese corporations were responsible for more than 30% of the foreign investment in the state, second only to the U.S. at 47%. Most of this investment is concentrated in basic manufacturing sectors, particularly automotive parts and electronics assembly. In 2023 alone, China allocated $3.5 billion to automotive original equipment manufacturing, OEM, in Mexico, highlighting its focus on foundational industries. However, it's not just about basic manufacturing.